everybody, welcome back. Thank you so much for dropping by today. For those of you who are new, hi there, my name is JoJo. Today's video is kind of one of my more unconventional ones just because of this financial strategy is a little more unconventional. And I do have an entire series going step by step into what this strategy is, the velocity banking strategy, how we are implementing it into our finances. I will link that playlist up here if you guys want to check it out. But the purpose of today's video is just to update this accounts tracker because of essentially what velocity banking is an interest savings strategy. It's where you use lines of credit, which are two-way, money flows back and forth freely to pay down large chunks of principal on amortized interest one-way loans. And that's really how it's an interest saving strategy. We have a home equity line of credit that has been at a zero balance since earlier this year, and I'm now down to the only interest loan that I have right now is my student loan, and it is a beast, you guys. It started when I graduated in 2010. I had, I think, around almost $80,000 of student loan debt. When I started this journey, I had about $78,000 of student loan debt. So really for the last 10 years, I've only been paying interest and I've just been making the minimum payments. 2 years ago, I decided to refinance my federal loans that had a 6.8% interest rate. I left about $10,000 of the 3.4% interest Fed loans with the Fed loan company and paid those off as soon as possible, taking advantage of the CARES Act this year, which that was so exciting. It really just gave me the momentum to tackle my beastly last student loan. It was refinanced 2 years ago for $68,000. It was a 15-year term and it has an interest rate of 4.75% interest. I am hoping that it is gone by the end of next year, and then we're just finishing up by paying off the HELOC part of it. But that is kind of my entire intention behind starting this strategy. And then we'll next move on to using it to pay off our mortgage. So as I mentioned, we're using our home equity line of credit. We transfer over $20,000 at a time. And we did that in August of this year. We made our first transfer and we're working through paying that off. But I house all of my accounts, or as much money as I can, within that line of credit. Since it's a two-way, money can flow back and forth, to hold that balance down for as long as possible and as many days as possible, because interest is accrued on an average daily balance with our line of credit. So each day matters for how much money is the bank is seeing as principal to charge interest on. So that is what I'm tracking here, is all the accounts that are housed within there, because I still need to use them for their intended purpose. Okay. Again, that's a lot to digest if you're just hopping in today, but I would refer you back to that entire series. I have a different transaction log that I use to track money as it's flowing in and out. I love using color code systems and check boxes. That's just how my brain works. And then I keep track of transfers as well to know when I need to have money sitting in my actual checking account ready to pay these different bills that require a checking account number. I don't really go too much into my transaction log in these videos. That's more addressed in my velocity banking series. But today what we're going to do is figure out how much money we have in each of these. So first, looking at how much money flowed into each account. The checking account had a total of $5,123.70 going into it. Sinking funds had $1,082.98 added to it. Savings, I gave that $75.48 to bump it back up to its usual $1,000, because if we are also to be more diversified in our finances, in our investments, investing a little into gold and silver. See, so then what was made as an actual principal payment to pay down that $20,000 in the month of November was $2,014.04. And when you add all these together, that totals $8,596.20. Money that had come out of the checking. We overall throughout the month had transferred $6,472.50, and then sinking funds we had used $2,123.70. Our savings we did not pull anything from, and then the cash flow payment of course did not have anything come out of it either, because that money is intended to stay there to pay off that principal balance. Then total money coming out was $8,596.20. Our ending amounts for each of these accounts. Checking ended with $6,635.32. Sinking funds ended with $3,189.03. Our savings is back up to its $1,000. Savings 2 is up to $1,800. And then total that we have paid on that $20,000 that we took out of the HELOC to pay down the principal on my student loan is $7,375.65. You add all these together, and that totals the $20,000 that we had taken out. Because of the balance that the bank is currently seeing on the HELOC is $0. This money had obviously been flowing in and out at different times. You can see it wasn't all this $6,000 that came out or $5,000 that had gone in. It was flowing back and forth at different times throughout the day, kind of depending on when different bills and things were due. But we're now ending with $20,000. It's ending with a 0. So the interest that I ended up paying, because there were some days when there actually was a balance, a principal balance for the bank to charge interest on. That interest, the interest we paid for the month of November was $1.47. So if you guys, knowing that we took out $20,000, we've paid off $7,375.65. We're not being charged interest on this $12,000, almost $13,000. Because obviously $1.47 would be, you'd expect a lot more interest on that amount, but we're only paying $1.47 because we've been using these accounts to hold that balance down, and are being charged as minimal amount of interest as possible. Interest paid overall since we started this strategy. So what I do is just add it month to month. We ended October paying $81.58 to interest, and then we'll add the $1.47. So interest overall that we've paid, it's not wanting to come up, is $83.05, and our HELOC ending balance is 0. All right. Now what I'll do is switch you guys over to my Excel spreadsheet where I'm tracking kind of a comparison of had we followed the standard method of using our cash flow to pay off the student loan as opposed to chunking away at it with the home equity line of credit and using our cash flow to pay down the home equity line of credit instead, and using these accounts to hold down that principal balance. So I I like to see those numbers, see the proof in my work. And so since starting this strategy, I was a little skeptical, and I kind of have that Excel spreadsheet to kind of prove to me that we do have money savings with this strategy. So that is going to wrap up the tracker. Now we'll move into the Excel spreadsheet and wrap it up there. All right, everyone, so here we are at that Excel spreadsheet document I was telling you about, where I have my two tables comparing this standard method called the snowball versus the velocity banking method, which I'm actually using. And on the main part I want you guys to look at right now, I'm going to fill out December on the snowball. This is where I put, had I been following the snowball method, how much money would I have actually thrown at debt for the month of November. And in November, I have thrown an extra $2,014.04 towards debt. And these are just hypothetical numbers over here, but down here in the velocity banking section, I can do my actual numbers. And down here is where I fill in the amount of interest that I actually paid for that month. So in November, I paid not 158.81 because these equations are not perfect. I don't know exactly what the lender is using to calculate their interest. I'm just kind of guessing that, but for the velocity banking table, as I mentioned, I can put in the actual numbers. So interest paid towards my student loan in November was $155.90. And the interest that I paid on my home equity line of credit was, $1.47. And then over here is the difference of those two. So this is my interest savings when you look at the interest paid using the standard snowball method, and then kind of subtracting the interest paid between my home equity line of credit plus the snowball, or plus the student loan. So let's just kind of see how much I have saved so far real quick. So I'm going to add these together. So just in the last 1, 2, 3, 4 months, or I guess it's, did I miss one? No. In the last 4 months since we've been following this strategy, I have saved $206.73 in interest. And this loan, as I have said in previous videos, that I'm hoping to have it paid off by the end of next year, and then I'll be left with just a little bit of my home equity line of credit to pay off, but the actual lender having to pay interest to the lender that my student loan is through, I'm hoping to be done with them and not really pay much interest on the little amount that will be left over to pay. That is my goal moving through going into 2021. But I am very excited to see our interest savings, that this strategy has worked for us. I hope you guys found this video to be helpful, if not interesting, to provide a little knowledge nugget. But that is going to wrap up this Velocity Banking monthly check-in for the month of November, how we did, how things are looking, and I will see you guys next week when I do my week 2 check-in for December.